Very good afternoon, everybody. I welcome you all for this Triple E program and meeting you again on this Triple E program. And we are here with the regulator Smarak Swain sir, who is from FATF cell of Ministry of Finance. And we welcome you, sir. Thank you very much for gracing this occasion and sharing your time and knowledge with us. Friends, in this on this occasion, I would like to mention few things about FATF. That FATF Task Force is an intergovernmental body which is responsible for setting up of global standards on anti-money laundering and combating the finance of terrorism. India became the observer of FATF in the year 2006. Since then, India has been working towards full-fledged membership of FATF. And friends, FATF membership is very important for India in its quest to become major player in the international finance, and India to build the capacity to fight terrorism and trace terrorist money, and to successfully investigate and prosecute money laundering, terrorist financing offenses. So in this total scenario, the ICSI, we the professionals, company secretaries, plays a vital role in involving the investment opportunities, exploring investments opportunities and compliances relating to investment, foreign investments in India. We play a major role, and we should be very conscious about our clients and about dealing with foreign currencies. With this intention, the ICSI has taken up today this session, that fraud risk arising from different crypto asset classification classes and implications for professionals. This is the title of today's session. Friends, our professionals, we being the compliance officers and financial advisors, lawyers, auditors, must navigate the landscape characterized by limited regulatory oversight. And there are rapid technological innovation is coming up, and we need to get acquainted and learn more about these technological changes. There are a lot of risks associated with this kind of crypto new technologies coming up in the market, and with the professionals, we should know the in and out about these kind of technology, what are the risk factors aligned with, connected with these technologies. And friends, India's recent move to bring crypto assets underlying anti-money laundering laws has given significant implications for the crypto industry. Friends, enacted in 2002, the PMLA aims to prevent money laundering and seize property derived from the laundered money. Now, friends, ICSI, I would like to bring some of the initiatives of ICSI as per the coordination and discussions had with the Ministry of Finance. ICSI has brought a child portal in our main portal icsi.edu, stating that this child portal will consist of wherever company secretary is involved and becoming reporting entity, they should get registered under this portal. That reporting entity, whenever you are dealing with foreign currencies, or especially in incorporations dealing with clients' monies, or there are 6 major actions where you are involved. You need to register with it, and you also need to take a KYC, know your client details, and also customer due diligence, how company secretaries has to do, and being a designated, how a designated director will function, and how to report on suspicious transaction reports, how to make suspicious transaction reports. These all the things are made in the form of guidance, guidelines, and these guidelines are also available there in the month of May. By notification 3 and 9 2023, there are notifications placed in the child portal, as well as that the June notification also been placed. Guidance notes has been given for all the professionals. So I request all the members to, after this session, please go through once the child portal and get acquainted with the new things happening, and especially on AML, which is very serious in nature, and we being playing the major role in building this nation, we should be aware of all these factors. Now, with this brief introduction, friends, I I would like to introduce our great personality and being regulator. It is very rare occasion we will get an opportunity for regulator to be a speaker for the session. Normally we will be getting them as a for the guest as a inaugural or valedictory sessions, but we really appreciate that this regulator himself is coming forward to share his knowledge and thoughts about this subject. Friends, Mr. Smarak Swain sir is a director of FATF Cell, Ministry of Finance, Government of India. It is my proud privilege to introduce him. He is an electrical engineer from IIT Kharagpur and joined the Indian Revenue Service in 2008. He has done his master's in taxation business laws from Nalsar University, Hyderabad. Sir, I also belongs to Hyderabad, sir.
Okay.
Okay.
Very
He
nice to
has
see.
also completed his master's in public administration from Lee Kuan Yew School of Public Policy, National University of Singapore. He is working as director of FATF Cell, Department of Revenue, Ministry of Finance. He also co-chair working group on evaluations and legal issues in Eurasian group on anti-money laundering and countering the financing of terrorism. He is a deputy national coordinator for India's FATF mutual evaluation. He is also an avid writer. His book, like Loophole Games, in popular among the professionals. He also wrote books like Digital Fortunes and Great Indian Fraud. And friends, these books are available in Amazon. You can, buy these books from the Amazon and have a look at it to have more knowledge on these subjects. Friends, it is our proud privilege that to have him here as a speaker for today's session. And we would like to have more information and knowledge from him on various crypto assets. And with this brief profile, friends, I welcome him at this 12th session of Triple E 4.0 Master Knowledge Series. And on this occasion, finally, would like to just give an information that ICSI National Awards for Excellence in Corporate Governance are open for 2024. The applications are invited for corporate governance for listed entities and CSR Excellence Award for large, medium, and small categories. ICSI Business Reporting and Sustainability Awards, ICSI Lifetime Achievement Awards. Sir, it is all time for you, sir. We would be eager to hear from you on this latest subject.
Thank you. Thank you. Thank you, Venkataramanji. So to start off, thanks a lot for your kind words. Um, uh, and thanks a lot for having me here, Mr. Venkataraman, council member, and also Madam Deepa. And a very good afternoon to all the members of ICSI who are here. What I will do is that before I start sharing the presentation, I'll give a very small background of about 5 minutes about what FATF standards talk about with respect to professionals like chartered accountants and company secretaries. So FATF, among the FATF, what FATF sees is that FATF sees professionals as gatekeepers. Okay, gatekeepers in the sense they are gatekeepers for financial activities, and as gatekeepers, generally they would be privy to some transactions which they may find suspicious in nature. Because when you are involved in an activity where you find something suspicious, you are actually the frontline agent who is going to who would actually know if there's if the activity is suspicious, if there's a transaction which is suspicious. And FATF expects that professionals would report such activities, even of their clients, to the financial intelligence unit. Okay. And either through your institute or otherwise. So they have given that option. In India, we have a scheme in which you report to the Financial Intelligence Unit through your institute, through ICSI. You report suspicious transactions. Now, what are these suspicious transactions? Okay, and how do you get to know whether any transaction is suspicious or not? Okay. For that, there are two approaches that you have to follow. Okay. First thing is that as per FATF recommendation 1, you need to have a very good understanding of risk that you are facing, that your sector is facing. Let's say you are a professional who is involved in only incorporating companies. Then the risk that you are facing is maybe from only cell companies. Okay, so in that case, your focus should be your focus, or in your office, some some compliance officers' focus will be purely on will be largely on red flag indicators pertaining to cell companies. Some customer has come to incorporate companies, and he wants to incorporate at 10 to 15 companies at one location. So you get doubtful. Why does he want to get incorporate 10 companies at one location? Let us say some customer has come and you find that he's a politically exposed person. Okay, so you start wondering, a politically exposed person, he's starting a new company. Do I need to do an enhanced due diligence of this? Do I need to ask him any follow-up questions? Okay, if you do not find anything suspicious, then well and good. Now, these standards have been developed keeping in mind both Western countries and both developed countries and developing countries. And they have been implemented in a few developed countries also. And it has been seen from the implementation that when such a system exists, in which in a structural way, professionals are required to report suspicious transactions, it actually improves the integrity of the sector. It improves the type of clients, the type of customers that you get. Okay, and at the same time, it does not affect your business at all, because these suspicious transactions which are reported by any reporting entity, they're completely confidential, and there's a law against tipping off. So no one is going to tip off the customer that the source of the intelligence, or the source of the suspicion is this particular person. Okay. Now, as I said, okay, so the first thing is to understand the risk. If you do not understand the risk, obviously you will not become suspicious, right? So let's say you are mostly involved in the incorporation of companies. Okay, so the grounds of suspicion may be the address. Okay, it's the same address in which if you go to jobba.com, Jobba Corp, you'll see many companies are registered in the single address. Okay, or maybe someone is coming and he's saying he's talking with you, but he's not a director or a manager, but he wants to incorporate the company. Okay, so the director is someone else, the managers of the company are someone else, but he's incorporating the company. So is it possible that he's the Benami, he's the actual person, actual beneficial owner who wants to incorporate a company in the name of Benami owners or in the name of some mules? So these are some of the questions that will come to your mind. Okay. Similarly, whenever you're working for a company, let's say, okay, and the company is trying to make any investment. Let's say the company is in the nature of a private fund house. Okay, it's a private, is a family trust, or it's a public fund house, or it's a private equity company. Okay, or even it may be a normal company which wants to make a normal investment in cryptocurrencies. Okay, at that time, you may come across some activities which you may find suspicious. Okay, as a company secretary, you are a gatekeeper because a lot of documentation has to happen through company secretaries. Okay, so I'll give you a very simple example. Nowadays, the nature of Ponzi schemes and pyramid schemes have been changing over time. Some 30 years back, the nature of Ponzi schemes were very different. In fact, I remember I had read about Ponzi schemes for the first time in a book by R.K. Narayan called The Financial Expert. Okay, I remember, yeah, that is the name of the book, The Financial Expert. And that book he had released in 1952. And it was a book on Ponzi scheme. Okay. So after R.K. Narayan in 1970s, there was a very different way of doing Ponzi schemes. After that, in 1978, the Price Cheats and Money Circulation Schemes Act 1978 came because of the heavy losses that victims bore because of this. And then in 1990s, they changed their form. They started coming in the form of real estate companies. They said that we're real estate companies and you can invest in our company. After 6 years or 7 years, we'll give you either a property or we'll give you back your money with a very high return. Okay. After that, in 2010s, okay, they changed their form again in 2000 AD, between 2000 and 2010. They came out in the form of cooperative societies. yeah, they'll first make the victim a member of the cooperative society, and then the victim will make an investment. They will promise the victim a return of 20% or 25% in the coming 4 after 4 years or 5 years. And that is how they used to collect money in this time. In the case of Ponzi schemes, what we have, or pyramid schemes, what we have seen is that the earlier you detect such schemes, the better it is. The earlier LEAs get to know about such schemes, the better it is. Now let us take the case of a simple. Let us take a hypothetical case in which your client or your customer wants to invest in a cryptocurrency. Friends, very few people actually understand cryptocurrency because there's a lot of technology involved. Very few people actually try to explain cryptocurrency in a common in a common sense parlance for common people, due to which we most of us do not understand what is cryptocurrency. Some of the cryptocurrencies are very valuable, and they may go on to become the next digital gold. Okay, some of them may not be very valuable. Okay, they're genuinely decentralized cryptocurrencies, but they may go bust. A large majority of them are in the nature of securities, and most of them are and again, within this basket of cryptocurrencies which are in the nature of securities, uh, a large majority of them are either Ponzi scheme or pyramid scheme. On today's date, it is very easy to run a Ponzi scheme using cryptocurrencies because you do not have to go through bank accounts. You can be based in Mauritius, you can be based in Maldives, anywhere, and from there you can run an online Ponzi scheme. You reach out to customers through Telegram groups, through call centers, and you entice the customer to invest in their in your cryptocurrency, in your Ponzi scheme, promising them high returns. Okay, and LEA will never get to know about it unless a professional tells them. Why a professional will tell them? Because professionals are gatekeepers. The client always confides in the professional. The client always tells the chartered accountant and the company or the company secretary that, look, I want to make this kind of an investment. I've heard about crypto asset classes. I want to diversify my investment. I want to diversify my asset classes. So I want to invest in some cryptocurrencies. I find value in this specific cryptocurrency. So when they say something like that, how do you intelligently educate your customer? That is the first role of the of the CS and the CA, to tell their client about the risk that they are facing, the risk of fraud that they may be facing from cryptocurrencies. Okay. And after that, the second thing that they have to do is, if the client still goes, the second thing that they have to do is, if they find the cryptocurrency suspicious, okay, and the way they have behaved, if they find it suspicious, they can always report it through a suspicious transaction report. Okay, through a confidential suspicious transaction report. Now I'll be sharing my screen. Just give me one moment. Yeah. I hope you can hear me, all of you. Yeah.
Yes, sir.
So I'll start with
you can convert into slide mode,
the
sir.
regulatory cycle. Why we need to start with the regulatory cycle, so as to explain to you, because so as to explain to you what happens whenever a new technology comes. Okay.
Sir, sorry to interrupt you, sir.
Many of you must have heard about the two-pillar solutions for taxation of the digital economy. Okay, many chartered accountants know about it, and many company secretaries also fervently follow this issue of taxing the digital economy. So when the digital economy started growing in 1990s, at that time most of the governments were not aware about what they have to do. Okay, so then they actually did not come up with a tax law with a law to tax the digital economy. Okay, so it was only in 2012, 2013 when many of the large companies, many of the large MNCs of the world were digital companies, that the governments realized that, okay, we had to tax these companies. Not only tax these companies, we also had to bring some regulation for these companies. Those regulations are now coming, like data localization norms, data privacy norms. Europe came out with its data privacy norms for digital economy only in 2016. Whereas the digital economy has been here in this world for the last 30 years. And the innovations are happening so fast that before the regulators can respond, a next round of regulation is a next round of a next round of technology is coming up. So if you see the regulatory cycle, there are 4 steps. Step 1 is when a new technological or financial innovation happens. At this stage, there is no regulation because the government does not know about it. The government does not understand it very well. Most of the national governments do not understand about it. And so the technology prospers. Okay. When the technology prospers, then new loopholes come. And when new loopholes come because of these new technologies or technological or financial innovation, then fraud happens. You must have heard about the rise in the number number and quantum of cybercrime in the last 3-4 years. Why did it happen? It happened because of the fast way in which fintech grew in India, because of the rapid pace in which fintech solutions came in India. So when these fintech solutions came and the rapid way in which they grew, it was a good thing because it led to a lot of financial inclusion. But when this happened, a lot of cybercrime happened. Why this cybercrime happened? Because there were some loopholes which no one had really understood or no one had really identified. When these loopholes are identified, mostly because of the fraudsters, these loopholes were plugged down. This is the step 4, plugging down the loopholes through some regulations. Okay. Now, this plugging of the loopholes, it closes the loop of the regulatory cycle. Okay. Ideally speaking, step 2 and step 3 should not happen. After step 1, directly step 4 should come. Whenever a new technological or financial innovation happens, okay, you understand the risk from them, and you immediately come up with the regulation. So it is called proactive regulation. But what happens in theory does not always happen in practice. Because step 1, once a new technological innovation or financial innovation comes, you get to know about the loopholes only if you are running a sandbox, only if you are running a regulatory sandbox, and these businesses or these innovations are operating within the sandbox. You see what is happening in a sandbox. But inside a sandbox, in most cases, you cannot identify loopholes. You can identify loopholes only when it happens in large quantum, large volume, and that cannot happen inside a sandbox. So, in theory, after step 1, if you understand the risk from new technologies, step 4 comes directly. But in practice, the regulatory cycle goes through 4 steps: step 1, 2, 3, and 4. This is something that I had mentioned in my book, The Great Indian Fraud, which came in 2020. And I had also made an observation about which I have been getting a lot of feedback of late. My observation is that the regulatory cycle is ruptured. It is ruptured because the pace of technological and financial evolution is much more than the pace at which regulation can happen. The moment a new technology or financial innovation is coming, even if regulators are very, even if even if the policymakers are very proactive, they identify loopholes. By the time they bring about a regulation to close this loophole, okay, a new financial innovation would have happened, and it will present new loopholes. So the regulatory cycle is kind of ruptured. Now I'll go to the next slide. Okay, so that is on crypto assets. Okay, we have now understood the regulatory cycle. It was important to understand the regulatory cycle uh, because of what I'm going to say now. Okay, now crypto assets have been in vogue since 2008. Okay, in 2009. In 2009, the first cryptocurrency, that is Bitcoin, came into was adapted in a significant way within a small mass of people called the cypherpunks. Okay, it was in 2011, around 2011 or 2012, that mass adoption of crypto of Bitcoins happened.
Sir,
Okay.
your voice is
After that, there's no looking back. Bitcoin as a cryptocurrency has been quite
Sir,
successful.
your voice is
It
little
runs through a
breaking.
peer-to-peer network. It is a decentralized cryptocurrency in the sense that no one controls Bitcoin. It was started by Satoshi Nakamoto, and it is a pseudonym. We do not know who was the actual founder of Bitcoin. To show us that there is no face behind Bitcoin, he never really declared himself. So we really do not know who is the founder of Bitcoin. and Bitcoin cannot be controlled by anyone because it is completely decentralized. It cannot be hacked. Okay. And it cannot be based under the control of any central bank. That was the base idea on which Bitcoin was built. But of course, in the initial years, Bitcoin could still be manipulated. Why? Because those investors who held large amount of Bitcoins, they could offload the Bitcoins to the market to reduce the value of Bitcoin in the market. They could pull a lot of Bitcoins from the market to increase the value of Bitcoins. But over time, when a lot of people this started owning Bitcoins, now the ownership of Bitcoin is quite dispersed and quite sparse. Because the ownership of Bitcoin is very sparse and very dispersed, no one person is actually controlling Bitcoin on today's date. Okay. But this may not be true for other cryptocurrencies. Before coming to other cryptocurrencies, let us see why Bitcoin came in the first place. Okay. So you'll see many people say that Bitcoin is such a big innovation because it is based on blockchain, and it is a decentralized ledger, and blockchain technology is going to be the technology of the future. It is part of Industrial Revolution 4.0. Okay. They are not wrong when they say that blockchain technology will be part of the Industrial Revolution 4.0. In fact, Web 3.0, we are sitting at Web 2.0. Web 1.0 was a time when we used to have Internet Explorer for the first time. Okay. And then came Web 2.0. Now we are on the verge of entering Web 3.0. In Web 3.0, all the tech stack is going to be based on mostly blockchains. Okay. But you have to remember that the blockchain technology and its utility is a very different thing, and cryptocurrency is a different thing. Cryptocurrency makes use of blockchain to ensure its authenticity and its integrity. Okay. But cryptocurrency is not blockchain. That is the first thing that we need to know. Second thing we need to know is what problem did Bitcoin try to solve? Okay. uh, because if no innovation is of any use, I mean nothing. I can innovate. I can come up with a new cup. Okay, but that cup is of no use for the society, for the community, unless it is solving some problem. If it is not solving a problem, that innovation is useless. Okay. So what problem is Bitcoin trying to solve? Many people have asked this question. Those who actually know shy away from this question. They do not want to give an answer to this question. I will tell you what the answer is. There's a problem that rich people, that HNIs have been facing for the last 2000 years or 3000 years. Okay. That problem is that of ownership rights and anonymity. Okay. You can have ownership rights or anonymity. You cannot have both. Let us say you have wealth. Okay. You want to protect the wealth from some creditor. Okay. Or you want to protect the wealth from the king. 1000 years back, you were a businessman. You wanted to protect the wealth from a king because you know that the new king is moody. He can because his treasury is empty. He can come any day and just grab your money and go away. Okay. So to protect your money from the king, you do not declare your wealth. You have a bag of gold, you do not declare it. Okay, you keep it hidden in your house, or you keep it hidden in your backyard, or you dig up a hole in your garden and keep it there. Okay. So the government, the king never gets to know about it. Because they do not get to know about it, you actually do not have ownership over that gold. So tomorrow, if some robber comes into your house, they'll dig it up and they'll steal it from you. You cannot complain to the police. Why? Because you have not reported it to the government, to the king. Okay. So you do not have clear ownership rights. Now, if you want clear ownership rights, you will declare, you'll put it in a bank where it is safe. No thief can steal it. At the same time, you will have to report it to the king. Another example is if I'm using a Benamida. Okay, I have unaccounted property, unaccounted wealth. I will keep it in the name of I'll buy some land or some property in the name of my cook. Okay, so my ownership rights over that property is not clear. Tomorrow my cook may try to double cross me. In investigations, we come across many such cases where the Benamita tries to double cross the owner. The cook will try to sell that property, or the cook will try to run away with that property. They may do something about it. Okay. So when I want to maintain anonymity of the property, I do not have ownership of the property. But if I want to have ownership of the property, then then I will put it in a bank, but the government will get to know about it. The taxman will get to know about it. The creditors will get to know about it. My ex-wife will get to know about it. Okay. So, and a lot of people, a lot of kidnappers who want to kidnap, will also get to know about it. Okay. So these rich people, okay, HNIs, they were always in the lookout for a solution. This solution came in the form of, in two forms. One was tax havens, okay. One was tax. Okay, so it came in in two forms. The first form was tax havens. You go and keep your wealth in a tax haven. You show your passport in the tax haven. You go to a bank in the tax haven. You show your passport and then you keep your wealth in that bank. You deposit your money in that bank. So you have clear ownership rights. At the same time, there's anonymity because banks used to maintain banking secrecy laws. They used to have banking secrecy laws in tax havens. Many of these tax havens used to have very stringent banking secrecy law. In fact, in Switzerland, if you try to steal any bank data from a bank, any private data from a bank, you can be punished with, you can be hanged to death in Switzerland. If you do a heinous crime, even then you will not be hanged. You'll be put in jail for 20 years or 25 years, probably. We have to see. But if you steal any customer's data from a bank, then you can be put to death. Okay. So this was one of the solutions for, for maintaining ownership rights and anonymity at the same time. In no one, the government in India will not get to know about it. The taxman in India will not get to know about it. Another way was through cell companies. Okay, you incorporate a bunch of cell companies. You have a friend who is who is not a company secretary, because company secretaries will not promote this kind of an activity. You have a friend who is very resourceful. He approaches different company secretaries, and through them he tries to incorporate different cell companies. Okay, and then you create a web of cell companies, and then you put your wealth under this web of cell companies. So your beneficial ownership is not very clear to the government or to the authorities. Okay, it's not clear to the authorities. At the same time, you are controlling this wealth. Okay, so your ownership rights and anonymity, both of them are coming together. So these were the two solutions. Now, what has happened after 2008 subprime crisis is that G20 countries, they came together and they imposed a lot of norms on these tax havens. Many of their secrecy law were undermined, and they were forced to withdraw these secrecy laws. On today's date, these tax havens, they share a lot of information about customers who are from a specific country to that country. Okay, so that ways the tax havens have been compromised. Number one. Number two, cell companies, the beneficial ownership rules, BO rules we call them. In India, we call them SBO rules, significant beneficial ownership rules. Okay, BO rules have become more and more stringent. And also many countries are acting against cell companies. Like for example, in India, we had a task force against cell companies, which worked very diligently to weed away many of the cell companies. Okay, so because of this, it has become even more difficult to hide wealth through cell companies. Now, what is the way out? The way out is Bitcoin. That is what Bitcoin actually promised to people. And that is why Bitcoin was adopted in the first place. And those cypherpunks who were the initial who were the people who initially adopted it, they knew that Bitcoin was solving a problem, but it's not a good problem. Bitcoin was solving a very negative problem. Bitcoin was very anti-establishment. They knew about it, but still they knew the potential of Bitcoin, and that's the reason why they they started using Bitcoin. Okay, and over time, a lot of people, they started adopting Bitcoin. Okay, and the initial people who adopted Bitcoin, in fact, the first use case of Bitcoin in proper economic activity was in the Silk Road. Was in the Silk Road. The Silk Road, the first Silk Road was started in, which is a part of the dark web. It was started in 2011. Okay, it started in 2011, and it transacted only in Bitcoins. And that is the reason why Bitcoin gathered a lot of momentum and a lot of popularity. But over time, if you see after 2016 or 2017, Bitcoin has become a mainstream asset class in itself. Okay. On today's date, no one is talking about the reasons for its origin. No one is talking about how it can be misused. On today's date, many people are actually seriously consider it as an asset class. Many international fund houses invest in Bitcoin. Okay, they have a diversified portfolio of assets. They invest in Bitcoin. Okay, we'll come to that. Okay, but before we come to that, let us see what are the risk of cryptocurrencies. No, let me come to that first. Okay, so why is Bitcoin so popular, so valuable on today's date? Unfortunately, it is valuable because of its network. Okay, so in my book, this book which I have published recently called Digital Fortunes. In my book, what I've explained is that Bitcoin is valuable because people think it is valuable. In initial days, it was people started adapt some some people started some individuals started adapting it because of its negative usage. But on today's date, okay, Bitcoin is valuable because people think it is Bitcoin. So just like gold, why is gold valuable? Okay, instead of gold, you can always use a fancy ornament also, which comes at 10 rupee or 5 rupee. Okay, you use gold because people think it is valuable. Some 3,000 years back, gold used to compete with many other currencies to become gold. So there was conch shell, which was very much in vogue in Eastern India at that point of time, conch shells. Then there was silver. Okay. But there were some particular features of gold due to which it gathered more and more network effects. Please mind my words. What I'm saying is network effects, which means more and more people started believing that it is valuable. On today's date, almost the entire world believes that gold is valuable because everyone believes that it is valuable. So we say that, yes, gold is valuable. Okay. There's no other reason why gold is valuable. It is valuable because people think it is valuable. So that is called network effects. It's a concept about which you'll find more in my book and also in many online resources if you go through it. Okay. So that is about Bitcoin. What about other cryptocurrencies? Now the thing is that after Bitcoin came, many other cryptocurrencies came into vogue. On today's date, there are more than 10,000, more than 8,000 cryptocurrencies which have been listed in coin. There's a database called Coinbase. So the Coinbase maintains a database of cryptocurrency listed cryptocurrencies. So last I remember there were more than 8,000 cryptocurrencies. Now, in the case of Bitcoin, it is understood that Bitcoin is completely decentralized. It cannot be hacked. It has assumed some value because so many people think that it is valuable. Okay. But what about other cryptocurrencies? So now we'll go into other cryptocurrencies. But before going into other cryptocurrencies, let us look at the fraud risk of cryptocurrencies. In this slide, I have shown you all the reasons why you should not invest in cryptocurrencies.
Sir,
okay. So there are many reasons why people should not invest in cryptocurrencies. I have been telling that 4 years back when I came out with the book Great Indian Fraud. I have been telling that in 2019. In 2019, I was working in the income tax department. Income tax department. My view here is completely personal view. The view that I'm giving. I'm not giving any view on behalf of any government agency or on behalf of the government. But since the time it has come, I have been working in the income tax department and I have seen it very closely. In my personal view, I have always told people that look, it has a lot of risk. Okay, it is cryptocurrency is a highly risky investment. Okay, and these are some of the risks that you have to see in cryptocurrencies. However, in spite of this, there are many people who invest in cryptocurrencies. If there is a person who wants to invest in cryptocurrencies, at least he should understand what is the difference between different kinds of cryptocurrencies and how to differentiate different kinds of cryptocurrencies. On today's date, if you ask my personal opinion, I will not stop you from investing in cryptocurrencies because when as an asset class, it has become so mainstream. And when so many MNC fund houses are investing in cryptocurrencies, okay, I will not. I'll not stop you from. I do not stop anyone from investing in cryptocurrencies. It is possible that Bitcoin or Ethereum, another currency, in the future they may become gold. They may become the next gold. They may get gold standard. So on today's date, if someone understands that and wants to invest in cryptocurrency, wants to invest in Bitcoin or Ethereum, I can understand the rationale for that. So today you invest at a small price. After let's say 20 years, it is a gold. it's a next gold, so you reap the benefits out of it. Okay, so that possibility is there. The risk is that there is a risk that it may completely go down, but there is also an opportunity that it may become the next gold. At the same time, there are many cryptocurrencies which will never become gold. We know very clearly that they will never become gold. Most of them are in the nature of Ponzi schemes. So how do you identify them? Okay, that is the question which we'll solve today in the next 20 to 25 minutes. Okay. Before going into it, let us look at two case studies. The first case study, which many of you must have heard about, is the case study of Satish Kumbhani. Okay. So Satish Kumbhani was an entrepreneur of the wrong sorts. Okay. He came up in 2016. He came up with the cryptocurrency called BitConnect. And he started selling BitConnect tokens all over the world. In 2016, November, demonetization happened. In November and December 2016, he in fact got a very good launch pad for selling BitConnect within India. He went around and told people with black money that you can purchase BitConnect using your black money, and your black money will be safe. By doing that, he collected a lot of deposits in old currency from people, and then he laundered them. That is what he did in 2016. But in 2017, he actually went global. Okay, he started a network of agents and commission agents all over the world, and he converted his BitConnect into a proper pyramid scheme, due to which there were agents in US selling BitConnect to people in US. There are agents in South Korea selling BitConnect to agents in South Korea also. Okay. And by 2018, what happened is that as it happens, the pyramid scheme unraveled. Why it unraveled? Because he used to give some 20% commission to his agents, and he was promising a monthly return of as much as 10% to the customers. So naturally, it will fall under its own weight. So in 2018, it went bust, and after that, you won't believe it, the FBI came into India to find him. The FBI could not find him. And he had defrauded a lot of customers in the US. He had defrauded a lot of customers in South Korea, some customers in China. So he had gone really global about it. Okay. So how did it happen? As I told you, Bitcoin. I told you about Bitcoin, right? Bitcoin is on blockchain, and because it is on blockchain, it is completely decentralized. If some currency is completely decentralized, okay, how can you commit a Ponzi scheme using that currency? Okay, he did that. He did it because he was only saying that it is decentralized. It was actually not decentralized. It was on a blockchain. You can open any currency on a blockchain. But if you want to maintain an administrative control, you can always maintain an administrative control. So BitConnect was nothing but a token. Okay, it was not really a decentralized cryptocurrency. Okay, it was a token over which he maintained administrative control, and he maintained very strong administrative control. And what he did is he did something very simple. He said, you take BitConnect and you give me money. When you sell the value of the BitConnect is going to rise. When it rises, you can sell the BitConnect back to me or to someone else, and you can take your money. And the return that you'll be getting will be at least 10% in a month. That is what he promised to people. He said that the value of BitConnect will automatically rise, but the value of BitConnect was not automatically rising. So what he did is, because he was in control, he had administrative control over BitConnect, so he artificially increased the value of BitConnect. From here, we see one thing, that if a cryptocurrency is not truly decentralized, okay, there's a very high risk of that cryptocurrency being manipulated by the promoter or by the administrator. There's another reason for this, because virtual assets actually do not have any regulator in India. There's an AML safety regulator, which is FIU India, but a proper sectoral regulator is not there in India, in many countries, in fact. In fact, in the US also, there is no proper sectoral regulator. There is no unified regulator. They regulated it using the existing laws. Whatever existing laws they have, using that, different agencies are doing different kind of regulations. But there's no sectoral regulator for cryptocurrencies in the US as of today. They came out with a bill recently, which if passed will create a new regulator for cryptocurrencies. So because there is no regulator, if there's any administrative control or if there's any control of a promoter, then it can very easily turn into a fraud. Okay. The second case study is again another interesting one. It is called Bitcoin scandal, which was done by the Bitcoin Ponzi King. We call him the Bitcoin Ponzi King, Amit Bharadwaj. Uh, he's called a Bitcoin Ponzi King, and he defrauded people using Bitcoin. But again, it was not the fault of Bitcoin. Okay, that he defrauded people. What he did is that that was a period of 2015 2016 when people were not very much aware about Bitcoin. Even now also people are not aware about Bitcoin or cryptocurrency. So what he did is that he went online on social media and he reached out to many people all over the country through social media, and he told them about the benefits of investing in Bitcoin. Okay. After that, what he did is that he came up with this scheme that you give me money, I'll buy Bitcoin for you and keep it with me. Okay. So see, if I am an investor, I pay money and I get Bitcoin in my wallet. Okay, then it's very clear that I'm maintaining control over it. I have the absolute ownership over the Bitcoin. Okay. But in this case, Amit Bharadwaj said, you give me money, I'll buy Bitcoin and keep it for you. And people were happy to do that because people did not understand how to maintain wallets. At that time, all these exchanges had not come. Exchanges are operating very user-friendly wallets, custodian wallets. So at that time, this was not possible. So you had to either go to a foreign exchange or you had to start your own private wallet, which needs you to understand the system of blockchain. So people thought it very easy that we'll give the money to Amit Bharadwaj and he will buy Bitcoin and keep it for us. And Amit Bharadwaj actually bought Bitcoin, and he told them that as the value of Bitcoin increases, you'll get 10% return. I'm at least assuring you a 10% return per month. Okay. So after he did that, on his website, he kept writing the names of the customers, that these customers have this many number of Bitcoins, and they have this much amount of fixed returns that they'll be getting. After some time, some of the customers, they went to him and asked him to reimburse their Bitcoin along with the profit. Okay. It was at that point of time that he became evasive. Okay. And in fact, what he did is that he came up with his own cryptocurrency, MCAP. He called it MCAP. And he said, you do one thing, instead of, in place of your Bitcoin, I'll give you MCAP. And after you get MCAP, its value will increase by 10% every month again. So that was the second round of fraud that he did on his customers. And again, in 2016, it was the end of 2016, people understood that it was a fraudulent operation. And then many people went and complained to the police. By that time, he had left the country and he had gone to Dubai. Most of his assets are still not traceable because he kept his assets in Bitcoin. He might have encashed his Bitcoin in Dubai. We do not know. He was caught through a red corner notice and brought back to India. And after coming to India, he in fact did a negotiation with his customers. He wanted to do a settlement with his customers. Very recently, I have got to know that he died. So this is the story of Gatekeeper Connect. So because of this reason, what I have done is that I keep meeting people who try to understand the money laundering risk, terrorist financing risk, the risk of predicate offenses like fraud and corruption from various vantage points. They try to make analysis from various points. In my discussions with them, I came up with this idea that there can be a fraud risk map over cryptocurrencies. Okay, we can at least tell people that where the risk of fraud is high, where the risk of fraud is low. Okay, and then I came up with this fraud risk map, which I have discussed in my book to explain it very shortly, in a very short way. I divide all the currencies into three parts. Okay, into three types. One is D token, which is fully decentralized. One is C token, where there is clear control by an administrator or a promoter. And there is one PD token, which is partially decentralized. Okay. So a fully decentralized token like Bitcoin, okay, has very low risk of fraud. In fact, it is completely Bitcoin is fraud proof. Most of these kind of cryptocurrencies, which are completely decentralized, they are largely fraud proof. And then there are C tokens, that is centralized tokens, where the fraud risk is high, because there's significant promoter control. Okay, let's talk about, for example, Ripple. Okay, Ripple, I don't know what has happened in recent years, but about 2 years, till 2 years back, it was it was a token which was completely under the control of a promoter group. Okay, so because it is a centralized token, okay, the risk of fraud automatically becomes very high. And then there are other tokens which I would put in the category of PD, that is partially decentralized. The risk of fraud is medium, but we need to see how much of central control is there to understand how much of fraud risk is possible. A very simple example I have given you here. Okay. Other than that, I will give you another, this is one formula. See the degree of decentralization and centralization. There's another dimension that I wanted to discuss with you. That dimension is this: whether a cryptocurrency is in the nature of securities. Okay. So ideally, under SEBI Act, okay, under Section 13 and 12A of the SEBI Act, if you are raising money from the public, okay, you need to you need in any way, if you're raising money from the public, okay, promising them some kind of returns, okay, you are either an IPO or you are a CIS. You're basically a securities, okay. And if you are a securities, then as per then as per SEBI Act, Section 12A and 13, if I'm not wrong, you are a collective investment scheme. In fact, no one can raise money from the public at large without going through IPO route or CIS route. And both of these routes are controlled by SEBI as the sector regulator. Okay. So ideally, if there's any instrument which is in the nature of securities or derivatives, okay, you have to knock on the doors of SEBI and you have to tell them that, look, I am running a collective investment scheme. You please give me a license. Most of the cryptocurrencies in vogue today, okay, are in the nature of securities, but they do not have any license from SEBI. Okay, so ideally, if you ask me from my personal perspective, if you ask my personal opinion, they are on the wrong side of law. And why is there a SEBI? SEBI is there to protect investors. If anyone is investing in this kind of cryptocurrencies, which are in the nature of securities, okay, then that person is taking a risk because he does not have the shelter of the regulator. Because these cryptocurrencies, they have not gone to SEBI, they have not got the license of CIS, collective investment schemes. Okay, so you need to be careful about it. So how can a company secretary understand whether a set cryptocurrency X is a securities or not? There's a very simple test. It is called Howey test. You can do a Howey test and find out if a specific cryptocurrency is in the nature of securities or not. Broadly speaking, okay, if anyone is pitching a cryptocurrency, okay, giving some kind of an indication that as an investor, if you buy this cryptocurrency, tomorrow you're going to make profits. Very simple. You're going to make capital gains, or you're going to make profits, or you're going to get some return. Okay. If there's this kind of a cryptocurrency, broadly speaking, then there is a good chance that he passes the Howey test. And if it passes the Howey test, then it is in the nature of securities. Okay. The exact nature of Howey test is a little difficult to discuss here at this point, but this is broadly what Howey test is. And Howey test has been referred to in India also. In Indian judiciary has also made use of Howey test to understand if some instrument is in the nature of securities. So it is not that Howey test which was evolved by the Supreme Court in US does not work in India. It works in India also. Okay, because it has the case laws in India which show that Howey test is very much valid in India as well. Okay, so now we have learned two things. First thing is whether the cryptocurrency is completely decentralized, completely centralized, or partly decentralized. Second thing we understood is Howey test whether the cryptocurrency is in the nature of securities. Using this, we can brand each and every cryptocurrency into some risk category. We can put them into some kind of a risk category. Let us do that. Let us look at various coins that you will hear about. One is called altcoin, and then we have stable coins, we have utility coins, we have privacy coins. altcoins are coins other than Bitcoin and Ethereum. Bitcoin and Ethereum are the famous ones. Other than Bitcoin, if there's any other currency which claims to be like Bitcoin, they're called altcoins. Whenever you see an altcoin, do not take it on face value. Do not assume that it is like Bitcoin. Do not assume that it is completely decentralized. You start asking questions about what this coin is about. What is the structure of this coin? What is the architecture of this coin? What is the algorithm that is being used? And how much of control the promoters have in this coin? You'll get a lot of resources online also, writings by experts also, comments by experts also, which will help you in understanding this currency, how much of central control there is on altcoin. Then we come to stable coins. Stable coins are completely centralized. In fact, what is a stable coin? Stable coin is a token which is backed by US dollar. It can be backed by US dollar, or it can be backed by any other real asset like gold or pound or even Indian rupee also. Okay. It is a token backed by US dollar. Now, what is the problem with stable coins? Stable coins should be more secure, more safe, more fraud proof than any other coin. Wrong. Why? Because again, it is a token backed by US dollar. So let's say I am starting a stable coin. Okay. I will say that it is backed by US dollar. So if I'm issuing 10 stable coins and each stable coin is equivalent to $1, then I have to keep a reserve of $10. Have I actually kept a reserve of $10? Have I actually, because it is centralized, because there is central control, have I actually kept a reserve of $10 when I'm floating $10 worth of stable coins? You will never get to know. You will not get to know. There are some stable coins. What they do is that on their website, they clearly mention how much of reserves they have. And they also give you evidence that they have kept this much amount of currency in a bank account. And this is the evidence. Okay. But most stable coins do not do that. So you do not know what I am doing with the money that you are giving me. If there are 10 stable coins backed by US dollars, we do not know if actually that much of reserve is there or not. And the funny thing and the tragic thing is that because there's no regulator, so there's no one to oversee me. I, as the promoter, have immense control over the currency. I can always misuse the currency. On top of that, there's some stable coins, which we call as algorithmic stable coins. These stable coins actually do not have any reserve as a backing. They have some kind of a logic as backing. They keep a very small reserve and then they use some kind of a logic, okay, to tell you that these coins are stable. Okay. But actually, when there's no reserve to back it, what is the point of having that coin? That coin is still very risky because number one, it is completely centralized. And number two, there is nothing to back it. Bitcoin does not have any underlying value. There's no real asset to back Bitcoin, but it is completely decentralized. So whatever value you see is a value that has come up from the general view of mass. But in the case of this kind of algorithmic stable coin, there's no asset to back you, and you're completely centralized. They're extremely highly prone to fraud. Then we'll come to utility coins. Utility coins are basically native tokens which are used within a blockchain. Now, let's say there's a blockchain which has some utility. Blockchains can have different utilities. We are still exploring the utilities of blockchains. There are different ways in which blockchains can be used. Recently, I heard about a new blockchain solution, which will work as Uber, but which will not take any commission like Uber. So it will only connect the buyer and seller. Okay, fair enough. But for running that kind of a blockchain, you may need a native token. The most popular utility coin in the world is Ethereum. Why? Because most of the developers in the world of cryptocurrency, most of the developers in the world of blockchain, most of the developers in the world of Web 3.0, they are developing smart contracts. They are developing different utilities on the Ethereum platform. Because they do it on the Ethereum platform, they need to use a native token called gas or ether. Okay, so that ether is basically Ethereum. Okay, and then again, Ethereum, it is quite decentralized. It is mostly decentralized. in its initial years in 2016, it faced a hacking attempt. Okay. So as to undo that hacking attempt, it actually deleted a part of its ledger. But that happened only with a consensus among all the members, members who held Ethereum. So on today's date, if Ethereum has to be manipulated or okay, then it needs consensus of all the members of everyone who possesses Ethereum, which is impossible to do on today's date because it has very wide and very dispersed, very diffuse membership. And then there are privacy coins. Privacy coins like Monero, they're extremely risky. Countries like the US have banned privacy coins. Why? Because they enhance they come with specific privacy enhancing features, due to which they are prone to money laundering, due to which it is very easy to use them to do terrorist financing or money laundering on the dark web, and it is very difficult for law enforcement authorities to track them or to trace them. It is still easy for them to trace or track Bitcoin and to see where Bitcoin has been exchanged for fiat currency, on which exchange. And it is easy for them to maintain control over the exchange, maintain KYC over customers on the exchange. But in the case of Monero, in the case of privacy coins, it is extremely difficult to do that. Okay, so I gave you a very small perspective about all these kinds of cryptocurrencies. And then now I come to this classification. This classification has been developed by me, but I will not take the credit for that because the many experts and with understanding of fraud, with experts in the sense LEA experts, FIU experts, and regulatory experts who sat together and gave me this idea. This idea that I came up with initially, I changed it from time to time based on the feedback that I received from experts from various domains, mostly fraud investigators and money laundering investigators. So it's a very simple thing. First of all, when you see a virtual asset, okay, you do a Howey test. Okay. So if it passes the Howey test, then it is a securities. Then it is then the risk is very high, and it may very well be a Ponzi scheme also. Okay. And depending on your judgment and depending on what kind of risk parameters have been given to you by ICSI, by your SRO, by your regulator, you can take a decision to file a suspicious transaction report about this currency. If you have seen some kind of a transaction happening in this kind of currencies. But if it fails Howey test, then you have to go to the next layer. You have to see what kind of central authority is there. If there is no central authority, then the risk is low. Then it is very low risk. Just like in the case of Bitcoin, there is no central authority, no one can control it. So the risk is low. Risk of fraud is low. If there is central authority, then you have to ask the next question. What is the level of transparency and whether there is a regulator or not? Okay. So if there is no sectoral regulator, okay, or if transparency is not well maintained, okay, then the risk will be medium high. The risk will be medium high. Okay. But if there is a regulator or if transparency is being maintained, okay, but let's say whoever is maintaining the central control, he's putting on his website all the details. Okay, he's explaining how the blockchain is working, and third parties are vouching that yes, this is how it is working. The administrator does not have is not maintaining any other control. It is maintaining fair control, and it is completely transparent with you. Okay, then the risk will be not high. Okay, so this is how you can brand all cryptocurrencies into these four buckets. And it helps your customer, it helps you to educate your customer, it helps your customer to understand the fraud risk involving cryptocurrencies. Now, again, before concluding, I'll tell you one more thing, that what I have told you is basically the fraud risk. There are many other kinds of risks that cryptocurrencies face. Okay, but our idea here is not to understand those risks. Our idea here is to understand the fraud risk from a consumer protection perspective and also from an awareness perspective, because you are gatekeepers. Your customers, your clients, they come to you. They come to you for financial advice. They consider you as financial experts. They trust in you, and they tell you things that they do not usually tell their wife. So you can also educate your customers. So with this, I will end. And more importantly, I want to take questions. Any questions, please let me know.
Thank you very much, sir, for your detailed presentation. Sir, even after listening to you on the subject in deep, we are also getting some more doubts and questions. With your permission, we will take one by one question, sir.
Please, yeah.
So the first thing is, as you explained that the cryptocurrencies, there are report how to report on suspicious transactions and when you can get suspicion on these transactions, whether transactions are risky or not risky. The first question is that is how this taxation treatment when we deal with cryptocurrencies will impact because it is mostly unregulated and there is no control over anybody. How the taxation aspects, because the bank accounts are connected with PAN, and whether banks, when they do regulated market transactions, because some of the banks will provide now, HDFC and all, in dealing with these transactions, how the taxation impact will be, sir?
Yes. A very interesting question. So let me explain how it happens. So what the tax pen have done is, okay, what the tax department, what the Income Tax Act has done is, the Income Tax Act has come out with a taxing regime, a different separate taxing regime for cryptocurrencies. It has said how much the capital gains will be, and you cannot set off the losses against the gains. That is what they have said. But more importantly, the Income Tax Act has put a liability on exchanges and brokers, okay, to deduct TDS. Now, exchanges and brokers, it is their liability to file a form, a quarterly statement called Form 24QS with the Income Tax Department. In this form, they have to declare who the customers on the exchanges are and how much of transactions they are doing on their exchanges. Okay. Now I'll tell you one thing. Okay. The many transactions which are happening through exchanges and also through brokers. Okay. But and on ramping and off ramping, that is converting a cryptocurrency into fiat currency, converting a fiat currency into a cryptocurrency, that also happens through exchanges. But there are many transactions which happen peer to peer, and the exchanges and brokers are not involved in those transactions, and the government never gets to gets to know about it. Very rarely the government gets to know, the authorities get to know about it, because these are peer-to-peer transactions from one private wallet to another private wallet. The beauty of private wallets is that they're completely anonymous. You will not get to know who is owning the private wallet. Let us say I am owning a private wallet. I have the private key. That by having the private key, I can stake my ownership over that wallet, but no one else gets to know who the wallet belongs to, and everyone can see the wallet online. You can see it now also, that wallet, and you can see how much of cryptocurrency is there in the wallet, but no one can know who the owner of that wallet is. So if there's a peer-to-peer transaction between two peers, okay, that can never be traced back to any specific person. So those transactions, on that there is no I mean, there's no oversight that the tax department has. It is unfortunate, but that's how it is.
Thank you, sir. Thank you very much, sir. If you see the journey of this cryptocurrency in India, when it started in 2013, somewhere where RBI has given a first notification that not to deal with virtual currency. In 2018, it has given a notification stating that there will be a ban on cryptocurrency. After that, the Supreme Court has struck down that ban. And now, though it is an unregulated market, the RBI has tried to give some instructions to the bankers that in dealing with like KYC and other norms. Do you feel this cryptocurrency dealing is really useful for the investors, or whether we shall go for this cryptocurrency dealings because of the risks associated with it?
Um, I'll tell you from a purely value investment perspective, cryptocurrencies do not have any backing. Okay, there's no real currency backing cryptocurrency. Okay, so because of that, many value investors they do not invest in cryptocurrency,
Hmm.
and they are fair. They are correct from their angle that you should not invest in cryptocurrency. At the same time, there are many people, mostly the Gen Y, the Gen Y generation, who invest in cryptocurrencies. Okay. Now,
Hmm.
among the cryptocurrencies, I can pinpoint two cryptocurrencies, that is Bitcoin and Ethereum, which have value not because there is any underlying value, but because they have a network of users. And because there's a huge network of users, the value automatically arises from the perception of all of these users that it is valuable. Other than that, other cryptocurrencies, I do not per se see any value. But if, but you know, in spite of that, in spite of many sane people advising against it, investors have taken a decision to invest in these currencies. So if anyone wants to invest in these currencies, at least they should be able to articulate the risk involved.
Oh, okay, sir. Sir, is there any, guide, agency which will assist the investors in evaluating the risk associated with the nature of the cryptocurrency where they need to deal?
Unfortunately, no. There's no agency which guides them. There are many people who write their advisories on in the public domain, but there's actually no guide, and that's where I think the professionals come. That's where the company secretaries and chartered accountants come. They can at least educate their customers because there's no
Oh,
regulator, there's no sector regulator. The regulator also, there's no one to come out with guidance from time to time, also giving them warnings about the risk involved or the uncertainty involved. And that's the reason why the role of the professional, the role of the advisor, financial advisor, becomes very important here.
actually, the major concerns are security risks as well as shield to crime and lack of liquidity, lower acceptability, and price volatility. So
Hmm.
So because of this, there is no one is in India is proposing. Majority of the people are not interested to deal with cryptocurrency. But is this Union Budget 2023? There was some reference that cryptocurrency this thing in the Union Budget. So how the government is looking into, sir, whether it is interested to encourage this kind of cryptocurrency dealings or not, only to regulate.
Uh, uh, okay, so let me tell you. I can tell you. It's not right for me to tell you how the government is looking at it. What I can tell you is that is how I look at it. So you asked a very valid question. Now there are three angles to any cryptocurrency. The first angle is an innovation angle, because we know that blockchain, not cryptocurrency, blockchain is going to be part of the industrial revolution 4.0, which is already happening. And industrial revolution 4.0 is a unique opportunity for India to leapfrog, because every time there's an industrial revolution, there's a unique opportunity for you to leapfrog other countries and become more developed. Okay, and take advantage of the new technologies that come in that revolution. So industrial revolution 4.0 is happening. The key components of this industrial revolution are 5G, artificial intelligence, and blockchain. So it is not wise, it is unwise to clamp down on blockchain or any innovation that is happening in the name of blockchain. So that is one angle. The second angle is that actually crypto assets, okay, they are actually not creating any value. They're actually not productive assets. Okay, so if they're not creating any value, if they're not productive assets, what is the point of investing in that? So there's no point of actually promoting people to invest in crypto assets.
Okay,
It
sir.
makes no sense to promote people to invest in crypto assets. And mostly, and you'll see in most situations, the people who invest in crypto assets, they are actually doing it because of all the wrong reasons. Okay,
Okay.
2 years back, there was a vigilance raid on one engineer in a small town in Bhubaneswar town in Odisha. Okay, when this raid happened on this engineer, the raid happened because there were complaints that he's engaging in corruption. When this raid happened, they could not find much of assets. However, what this person did is that he was very nervous. He rushed off to his table and he tried to tear off 2 or 3 pages of paper. Okay, when he tried to tear off these papers, the investigators they pieced together the papers and they tried to understand what is there in the paper. In the paper, basically, his private keys were mentioned. And then when they investigated the private key, they got to know that he had kept 1.75 crores worth of assets in cryptocurrencies. Okay. So what I'm trying to say is that, and taking a bribe in cryptocurrency is much easier because you do not have to take any bulky cash in your hand. You either take a cold wallet, okay, or you ask some person to transfer the bribe to your wallet. Everyone in the world can see the transfer happening from one wallet to another wallet. But because it is a private wallet, no one gets to know about it. I know how bizarre it sounds, but that is it. Most of the people, they still use crypto assets because of the wrong reasons. Then comes the third aspect. The third aspect is that the number of people, I'm not talking about cryptocurrencies here, I'm talking only about Bitcoin. The number of people who have adopted Bitcoin have reached such a huge mass. The number of people who are holding Bitcoin the number of individuals and institutions which are holding Bitcoin has reached such a significant number that on today's date, it has assumed a kind of a gold status. I won't say gold status, a kind of a demi-gold status. Going from here, it can either go completely bust, or after 10 years or 15 years, it can become the next gold.
Okay.
It can become a digital gold. And when I'm saying this, I'm not saying something which is completely out of the ordinary or something completely mind-boggling. You see, there are a couple of countries which have already declared Bitcoin as legal tender. Okay. After the Ukraine-Russia war started, US has imposed a lot of sanctions on Russia, OFAC sanctions we call it, due to which Russia is unable to make use of dollar for international transactions. So there are news reports that Russia is actively using Bitcoin for making international trade finance payments. So this is it basically. We see that now cryptocurrencies, not cryptocurrencies per se, only Bitcoin. Bitcoin is being used in a significant way, just like gold, and it has more liquidity than gold. Okay, it can very easily. It can be exchanged for fiat currency more easily than gold. So these are the three angles that I wanted to highlight to you.
Thank you very much, sir. Sir, one more thing is whether this cryptocurrency and regulation of official digital currency bill will help, in regulating this Bitcoin, cryptocurrency aspects, or how do you feel, sir? This.
The regulation will definitely help. There's no doubt about it. Regulation will definitely help. When there's a regulator, already there's a regulation by FIU India. So that has increased the level of transparency significantly. Okay. So if we get a regulator, the regulation will definitely help in improving the integrity and the transparency in the system. But the key problem here is that there are some transactions on which we can never get transparency. Like, for example, I will give you 10 rupees. Okay. So no one can monitor. RBI cannot monitor that transaction. I giving you 10 rupees. Okay. Similarly, when there's a transaction between two private wallets, okay, no one can actually know who is sending money to whom. Okay, that is a major problem here. Okay. So even if there's a regulator, the regulator will not have visibility over this. And let's say we have a regulator which gives legitimacy to some currencies, and then those currencies are swapped through private wallets. Okay, and then so that automatically increases the risk of money laundering significantly. So we call it the residual risk of money laundering. So that is a risk that cannot be mitigated, even if we have a regulator.
Okay, sir. Sir, in this situation, as a professional, kindly advise us how we can confirm the implementation of compliances in AML through KYC measures and to
Hello,
mitigate
I
the
didn't get
fraud
you.
cases
Can you
in
repeat your
Bitcoin.
question again?
In this scenario, sir, as a professional,
Hello.
kindly advise how we can confirm implementation of compliances in AML through KYC
Uh,
measures to mitigate these fraud cases.
just give me a moment. I think there's some technical problem. Just let me. Uh, just give me a
Are
moment.
you getting the voice, sir, now?
Uh,
Are you getting the
I can
voice,
hear
sir?
you now. Please,
Yeah.
please.
Sir, in this scenario, as a professional, kindly advise us how we can confirm that implementation of compliances relating to AML through KYC measures, especially to mitigate these kind of frauds, sir.
Mm, yeah. So the thing is that the way I see it, okay. So now this is something by which we do by largely by trial and error. First, we try to understand the risk involved, which we have understood in today's session. And after understanding this risk, what will happen is, let's say you come across some customer or some client, okay, who wants to do an investment in cryptocurrency or who wants to do a transaction in cryptocurrency. There are three things, three implications that you can draw. First is, why does he want to do a transaction in cryptocurrency? Okay, if he wants to do a transaction in Bitcoin, then it's understandable. In any crypto asset, why? What is his motivation for doing this transaction in crypto assets? Does he want to hide any asset? Okay, or does he want to engage in some kind of a transaction which can lead to laundering? Okay, so that is one question that they can ask themselves. Okay, so that is something they can be suspicious about. First question, which is against the customer. Okay, I would won't say against the customer, which is for the system. Okay, because the professional has a responsibility towards the institute, towards the country, as much as they have towards the client. Okay, then the second thing is, okay, for client protection. If they see a client who is innocent, who has legitimate money, but who wants to invest in crypto assets because his son or his nephew has told him that this is a very good asset class, why do not you invest in it? Or he wants to diversify his asset classes, so he wants to invest in crypto assets. Then in that situation, trying to understand what this crypto asset is, what kind of asset it is, who is selling this asset, and what is the USP of the asset, what are the features of this asset, and then trying to put that asset in one of the one of the four buckets that I mentioned some time back. Then there's a third thing. Uh, your client is receiving payments or any value in crypto assets. If he's doing that, okay, or let's say there's a company, okay, which is receiving value in assets, crypto assets, or if it is doing a restructuring in which some assets in in cryptocurrencies are being maintained, why is it doing so? What is its motivation for doing so? So these are the three things that a CA that a CS should be asking when he or she comes across this kind of transactions. And if they're unable to get a proper answer for these questions, then either they can do an enhanced due diligence, or they can file a suspicious transaction report. Secondly, if the client is a politically exposed person and is engaged in a crypto asset transaction, then it is extremely high risk. And so the professional, so it is wise for the professional to definitely do an enhanced due diligence before engaging in this transaction.
Very nice, sir. Uh, Sir, if what will be the underlying in any cryptocurrency, how the value is to be calculated, and when there is no underlying, how we will calculate its value, and who will be responsible if the investor, is not getting any or getting involved into the fraud, victimized by the fraud.
So I will tell you one thing first. Okay, as a gatekeeper, you are never held responsible for anything. Okay, that is the
Okay.
beauty of you as a gatekeeper. You will not,
Okay.
you are never held responsible for anything.
Mm.
I have seen some cases in which chartered accountants and company secretaries have been made co-accused in some cases for abatement. So that is a different thing altogether, in which the CA or CA knows about it. It's not that he's suspicious about something. He knows about something and actively helps the client in engaging in laundering or layering of funds. Okay, so that is
Okay. Okay.
altogether different thing. The gatekeeper or the professional is not responsible for what the for any wrong filing or any wrong declaration that the customer does. But if he
Okay.
finds
Okay.
something suspicious, he can report it to the FIU. I won't say that takes away his liability in any way, but he actually did not have any liability in the first place. Okay. So, that is the first thing that I wanted to say. There is no issue of liability here. Second thing is when there is no underlying value. It's true that there's no underlying value, but as we have seen, that in the traditional economy, the value is generated when there is any productive activity that takes place. I use my labor, or you use your machinery, plant and machinery. So plant and machinery and labor, either labor or plant and machinery, which is a depreciable asset, they are used to produce something. That production process itself gives rise to value. Okay, but in the that is the traditional economy. But in the world of intangibles, okay, value is generated in a little in a little more sophisticated way. And when we come to the digital economy, what we see is that value, the network, the network of users itself creates a value. So network effects give rise to value. Okay. I know it is something very difficult to fathom at this point of time, but you can also go through network effects as a concept. In fact, if you want, I can you can connect with me privately. Also, I can explain you later how a network effect works. And network effect works through Amazon. Also, you see any of the digital platforms. All of these digital platforms, you'll see that they make losses, but they still have some value, stock market value. Okay, so it is primarily because of network effects, because the network of users is so large that they themselves create a value. Okay, so in the case of cryptocurrencies, I know for sure that Bitcoin and Ethereum, they are valuable because they have a huge network of users. You can see the network of users, the number of users that Bitcoin has and the Ethereum has, or going online today also. You can see the amount of transactions happening in Bitcoin and Ethereum on today's date, because they have been seen as a store of value by so many people. Okay, that is how they're deriving their value from. Okay, and if all the people in the world start seeing it as a store of value, then it becomes gold. Okay,
Oh,
in 2010, in 2010, there were only about 10 people who saw it as a store of value. Okay, on today's date, there are crores of people. There are multiple millions of people who see it as a store of value. Individuals also and institutions also. Okay, so that cannot be completely negated in the case of Bitcoin and Ethereum. In the case of other altcoins, I cannot say where the value comes from, because yes, there's no underlying value. I don't actually see any underlying value. I have to again analyze the network of users to give you any hint about the value. Broadly speaking, none of these currencies have any value because there's no underlying value. The only value that they may have is coming from network effects.
thank you very much, sir, for your elaborative answers and patiently answering all our questions. Really, it's an enlightening session today we have, and got to know about many things, how the government is looking at these kind of cryptocurrency transactions. The one thing we would understand is since it is a unregulated market, the very conscious on dealing with these kind of currencies, and especially for the professionals when they are advising on the customers being watchdogs, we should able to assess the risk elements involved with the is transactions, and also to understand about client fully what is his position, why he wants to deal with it, and how he wants to deal with it. Based on that, if needed, due diligence has to be done in details, and we have to be, only to protect the investors, not only to protect the investors, to build the economy. Our role of professionals is most important. And because of that, only ICSI today has given guidance note and asking our members to be conscious when they make an application, incorporations, or not to give their official addresses for any other companies to have their address in their personal office or house addresses, and also not to be a directors without knowing, understanding the company's position and all. So friends, we had a detailed discussion with Smarak sir. He has wonderfully explained all the matters relating to cryptocurrencies and risks associated with it. Sir, once again, thank you very much for your wonderful
Thank you.
session. We will be keep disturbing you and getting this kind of having this kind of sessions from all of you. Friends, with this uh, concluding remarks, we can close this session. With thanks to sir and also thanks to all the members who has joined online. I hope you will definitely go through the ICSI child portal relating to PMLA and will understand what are the nitty and gritties of this PMLA in related aspects. Thank you, one and all. Thank you so much, sir, for your wonderful session.
Thank you. Thank you.